do you want to start by introducing yourself and
Sure.
the legal side of your practice, the estate side of your practice? I think that one complements the other in terms of this particular topic.
Okay. Well, my name is Scott Schweitzer, attorney, owner of Prime Settlement. That is a real estate settlement company. I work with realtors and loan officers to make sure that people's properties are being bought and sold efficiently, protecting their property rights. And Prime Estate Planning, where keep people's family out of court and out of conflict. And I've been working with Scott for several years. He's been part of a BNI networking group that I've been part of, and we've collaborated on business, and he's also a friend of mine. So I'm really happy to join him here today.
Thank you, Scott. Really appreciate your time. So one of the things that got me interested in finding out more about holding rental properties in trusts is because I have several clients who have decided to move from a private ownership of a property to a revocable trust. And as we found out, there are implications for the management of the property as well. So could we start maybe by, kind of sharing with us a little bit of what how you're advising clients on some of the benefits of moving in, specifically in the district, because it does have different regulations than other jurisdictions. But in the District of Columbia, of saying, hey, I have a property, it's currently registered in my name, but I would like to put it into a revocable trust. Can you talk a little bit about that?
Sure. And I think it's great that you set the context, which is the answer depends on where the property is located. In particular, like the rules governing rent control are different in DC than they would be in Maryland, Virginia, and other jurisdictions. So let me back up a little bit just for people who aren't familiar with estate planning. Why a trust? Why would you put property into what Scott mentioned correctly is a revocable living trust or a revocable living trust? And the answer is that's an estate planning vehicle that helps avoid the probate process, or it helps avoid a situation when you or a loved one passes away and your family then has to go into court to go through the probate process, which is a process that is set out for the benefit of your creditors. It takes typically 6 to 12 months. I find that it usually costs about 5% of the value of the estate. So if you have a $1 million estate, 5% of that would be $50,000. And it's public. So it can be a stressful, costly, and time-consuming event for a family to have to go to. So that's why people are interested in putting their properties, their primary residences, and even their investment properties into the revocable living trust. And I would say the benefits here of holding the property in revocable living trust is, again, saving money on court fees, helping your family avoid the delay and stress of the probate, and keeping your estate matters confidential and avoiding family conflict. As Scott was alluding to, there are some drawbacks. In DC in particular, you become subject to rent control when you move your property into anything that is other than your personal name. So it doesn't matter if you move it to an LLC, an irrevocable trust, which is a different kind of estate planning vehicle, or a revocable living trust. And I guess, Scott, you can speak a little bit more to what the implications of being under rent control are.
Sure, of course. So it is mostly an administrative burden. I tell clients if they are currently renting out their properties and the rent amount is pretty much close to market or at market, then the restrictions that rent control laws put into place for owners as far as the amount of increased rent that you're allowed to implement each year aren't as impactful as you might think. The rent control where it really becomes burdensome from that perspective is if you have a property that has been under rent control for quite some time and the rents are far behind what the market rents are. That's where owners start to get into trouble. But let's say you have a house that you purchased 5 years ago and the rents are at market. If you decide to do this and then go under rent control, if you are the minimum amount every year is 2% because that's just an add-on for rent control, and then it varies between 0 and whatever the CPI W has been for the previous year. So in the last couple of years, it's been pretty low, but I've seen years where it's 2 or 3%. That's a total of 4 to 5% that rent control would allow you. We've just found that the market rents can't support that big of an increase and still be competitive. So the owners aren't necessarily burdened if they have properties that have rents that are currently at market rate. So that brings us to another burden, which is administrative burden. So the administrative burden is not insignificant. First of all, you're registered as subject to rent control. There are certain things that happen, including some legislation right now with COVID, that apply to properties subject to rent control, but not to properties that are exempt from rent control. But the biggest is really that you need to get your annual increases if the market supports it. This has to be done on certain forms. Every time an applicant applies and signs a lease, there are forms they have to sign. Those forms have to be submitted to the rent administrator. You have to keep them aware of what's going on with the property. If the property is ever sold, then that rent control registration carries over to new ownership. So there is kind of more administrative, responsibilities that come with that, other than practical or business related ones.
Okay. Well, that's a good point. I mean, it sounds as if, if the cost is not a big issue from a rent control perspective, I would say the only other cost would be the effort and money needed to go through the estate planning process. But if you're somebody that's considering that anyway, then it certainly is worth it. And it just sounds like if you're going to have rental properties and you're going to put them into trusts, it might make sense to consider using someone like Scott Bloom, using his company, Columbia Property Management, to help ease that administrative burden.
That's right. Certainly having a property management company or even outsourcing the rent control part of your investment property to a third party is something that you could overcome. But like you said, it's just an additional expense and you have to weigh the benefits and the expenses.
And for you then, do you offer a variety of services or different tiers? Will you do the rent control administrative services without the management, or do you focus on the management?
We focus just on the management. We will handle the rent control portion if it is a managed client.
Okay, Frank, fair enough. So just back to the question originally, if clients are going through the estate planning process already, I generally advise them to put the property in the trust, because of the cost of probate alone will most likely be greater than the cost of adhering to rent control, like you said. And just to remember that estate planning is planning for when you die or become incapacitated. We all know when we die. We just don't know. We all know when that we will die. We just don't know when. So if you're thinking that you're going to hold the property in your own name and save yourself the cost of rent control or the administrative burden, and then when you get older and you're ready to die, then you put it in your trust, that's flawed thinking, because unfortunately we can't control when that happens. We can't control when we become incapacitated. We can't control when we pass away. All we can do is take the efforts and put the planning in place to make sure that when the unexpected does happen, our family is in a position where they're being taken care of.
Oh, great. That's really helpful. Are there any other considerations other than estate planning and passing the property along and avoiding probate that you could say would be a benefit of having it in a revocable trust?
Well, I think I want to make a distinction. A revocable living trust isn't the only way to hold your property. You can also, for example, put the investment property in an LLC. And some people, actually a lot of people, will contact me as a title attorney and say, hey, I want to move my investment property. I'm a landlord. I want to move it into an LLC, because the benefit of the LLC is that you have a limited liability. So if something goes horribly wrong with your investment property, if there's an accident, if you're subject to a lawsuit, you would have the option of shutting it down and walking away from it, and it would not affect the rest of your personal assets, the rest of your personal wealth. The problem in DC, again, with an LLC, with moving property into an LLC, is you will pay the full transfer and recordation tax based on the assessed value of the property when moving it from yourself to the LLC, even if you're the only owner or the only member of that LLC. So most people that contact me and say, hey, we want to do this, think again once they see what the price tag would be for that. Another challenge with owning it in an LLC is you've limited access to financing. You typically will not be able to use your personal credit. You will not be able to get a personal loan to utilize and to buy a second home or an investment home. You would have to get a commercial line of credit, or you would have to get financing from investors. And that's a great position to be in, but it requires a lot more experience and a lot more sort of advanced business model to have relationships with commercial banks and so forth in that context. If you have access to cheap commercial financing or the ability to pay with cash, then it might make sense to own this in an LLC and assign the membership interest to your revocable living trust. That would be kind of a key situation. You have both asset protection, limited liability, and a good outcome for estate planning. But it's tough to get there.
So you're going to bring up a really good point. So the main, so there's different vehicles depending on
Yes.
what you're trying to achieve. And then you can even combine the different vehicles to achieve multiple goals. But the main reason for the trust is asset protection from the perspective of wealth protection, presumably, because you won't have to pay the state for a certain part of that. So with a revocable trust, it's my understanding that the trustee is the individual themselves. So there's really no separate entity. It's basically just a vehicle to do some asset protection, but then it's clear that the owner is the individual. It's just, can you explain a little bit of how that separates it from the individual, but not really completely?
So the revocable living trust, when you're alive and you create that trust, there is unity. You are acting both as the trustee, so you're in control of it. You are the beneficiary, so you get the benefit of all the assets, and the trustor, so you're the one that is putting the assets in there. So there's no separate tax ID. You really have the same access to those assets as you would before, the same control, and you actually don't get the asset protection. So on those assets in the revocable living trust, what you do get is probate avoidance. So when you pass away, your assets are not going through the expensive, lengthy, and public probate process. But what I do for a lot of my clients is, in addition to having a revocable living trust, they will create an irrevocable trust. I call them a lifetime asset protection trust for their children, so that when they pass away, if they have minor children, or even if they have family members who maybe aren't great with money, those assets will not be distributed outright to those beneficiaries, and they'll instead be protected in an irrevocable trust. And the benefit there is there would be a third-party trustee that is managing those assets for the beneficiaries. If those beneficiaries have creditors, if they get into a divorce situation, if they have substance abuse or gambling problems, or if they just are the kind of people that make poor choices, their assets are still protected. You can still make sure that your beneficiaries use the money or grow the money in the way that you think is prudent. So that's an option that I see a lot of people choosing. And those irrevocable trusts do get their own tax ID numbers, and they operate a little bit more like LLCs in that context.
Okay, that's good. And thanks for contrasting that with a revocable trust. So with a revocable trust, it's really pretty much the probate avoidance, but not necessarily asset protection.
Correct.
The trustee is basically also the beneficiary or the person who previously owned the property, for example. So it really, it helps to shield a little bit the asset or the value, because you just avoid the probate piece. But it's really limited to that, correct?
Correct. So if you have your assets, if you have your investment property in a revocable living trust, it really helps your family out when you pass away. Avoidance of probate is one of the biggies, but the document itself is sophisticated enough and has enough details that you can add some bells and whistles to it to help with the planning. But it's not going to shield it from creditors and so forth during your lifetime. So that's where, during your lifetime, if you're concerned about that, that's where you want to think about creating an LLC. And honestly, I tell people that the best time to to put your property in LLC is when before you buy it, when you're setting up the deal. Think about whether it would make sense to purchase the property in an LLC. rather than buying in your own personal name and then transferring it later.
Okay, that's good. So we covered some of the benefits of a revocable trust, and for the irrevocable trust is more about putting the assets into a safe, if you will, that the person doing it, the grantor, I guess, no longer has access to the assets, can't have a say on what's happening with the assets, and that's put in there for the purposes of inheritance primarily. Would you say that's correct?
This would be like the lifetime asset protection trust that I spoke about, right?
Yes.
Yep, exactly. And it also can be an education tool. So you have the ability to make your beneficiary, let's say it's your kid, co-trustee at the age of 18, and or any age you think is correct. And that's when he will be able to see everything that the actual trustee is doing with the money. So he learns that he has these assets, and he learns what you wanted them to be spent on and so forth. So it's an educational tool for him. And then you can choose at a certain age, let's say 30 or 35, he then becomes the sole trustee. So he then has complete control over the asset. And he's at that age, there's still some protection from creditors, but he has the ability to make the distributions because at that point you think he's going to be wise enough to make the right choice.
Great. That's really helpful. And as far as, if somebody chose either kind of trust, it's really not going to be based on their rental property. The rental property is just one of the assets that they may have in the trust, and the decision to choose between the trust is made up on completely different criteria than whether or not they have rental property. It's
exactly.
just an application of what happens with the rental property. If they're engaged in managing the property, or if they have a property manager, but they still want to make all the decisions, then they can get, so it really depends on what they're trying to achieve in the trust, in one or the other kind of trust, or if they're actually looking for liability protection, which is more of an LLC route, or maybe even an insurance route to a certain degree, then it would be for a trust.
Yes, and I would say that a lot of clients that come to me that were going to move their property, their investment property, into an LLC, instead end up buying an umbrella insurance policy or a commercial insurance policy, because that can provide some of the protection without incurring the cost of the recordation and transfer taxes. So that can be a good stopgap measure. I would say that also, getting into the weeds a little bit, but the distinction between someone who has investment property as a landlord versus somebody who's doing ground up construction or development, I would say that if you're going to be a developer and you're going to be doing ground up construction and that's going to be your business, it's even a higher risk than being a landlord. There's so many potentials for things to go wrong that there really would make sense to start that business with the goal of building relationships, getting investors, friends and family investors, getting investment funds, getting commercial lines of credit, so that you can have LLCs or a series of LLCs set up for each of your properties, so that when something does go wrong, as it always will, I think, with developers, it doesn't impact the rest of your business and your personal finances.
Yeah, that makes a lot of sense. This has really been helpful, Scott. Are there any other things before we wrap up that you can think that are either a pro or a con in DC for having properties in a trust or keeping them in a personal name?
I would just say that the more properties you have, the more it makes sense to set up a revocable living trust for estate planning purposes, because people usually don't think about this, but if you have properties in different jurisdictions, and when you pass away, there will have to be a probate that's opened up with the court in all those jurisdictions. So people often have second homes, vacation homes, rental properties, perhaps in DC, Virginia, Maryland, perhaps across the country, Delaware. Their family will have to go through separate probate proceedings and probably hire different attorneys that are barred in different jurisdictions for each of those properties. So that's a really expensive and challenging task for their family to go through. If you create the revocable living trust, you can make sure those properties are all in the trust. It's going to be so much easier for your family in those situations.
Great. And the properties that are in the trust during a probate period, are those properties assessed at market value, or the net based on any outstanding liens or mortgages?
So it depends on if you're looking at it from estate tax purposes or for probate calculation purposes.
Okay.
For estate tax purposes, it will be assessed based on the equity that they have on the property. So they'll take out mortgages and liens and so forth. For probate purposes, if the property is going to go through probate, it'll be assessed just on the market value of the property. So that's
Wow.
what can get really expensive really quick.
Great.
And that's one of the main things that people don't realize, why it's really important to, to make sure that your properties are in a trust, that you have a trust created, and the properties are properly titled in that trust. Because people
Mhm.
don't realize how big of an estate they actually have. You may have 3 properties that are all highly leveraged, but for probate purposes, you may have several millions of dollars in that estate.
Okay, that's great. I'm so glad I asked.
Yeah. So, and
Good
people don't
stuff,
realize
Nate.
that, you know?
Any outgoing lessons learned or a client situation that you want to share as a good example?
I
Or
would say just that I have several clients who really didn't understand that their probate estate was so large and didn't realize what a burden it would be on their family. And I hear lots of stories from people who have relatives that passed away, unexpectedly, and they just have a multi-year probate process that has really made it tough on the family and put them in conflict and destroyed a lot of relationships. So it's not just the money; it's also preserving the relationships that you've helped to develop in your family, especially if you have kids.
great. Yeah, that's often something that people don't think about.
Right.
Well, thanks so much, Scott. I appreciate your time and all your great wisdom about these topics, and look forward to having another one of these.
All right. Well, thank you, Scott. Thank you for the opportunity. I appreciate it.